Bloomberg World Headquarters in New York, this is Street Smart with Carol Massar and Matt Miller.
All right, just a few minutes remaining until the closing bell. Joining us live from the CME Group is Bob Iacchino, founder and president of TraderOutlook.com. Bob actively trades currencies, metals, and stocks. Also joining us here on set is John Brynjolfsson, the chief investment officer at Armored Wealth and a former portfolio manager at PIMCO. He expects inflation will rise because of more aggressive Fed easing and that will boost the price of gold and other commodities beyond where they already are. He trades just about everything as well, I think I can safely say.
We have our limits.
You have your limits. All right, let's talk about the end of September, first of all, because we just looked at one of the charts of just the S&P, but I was looking over your shoulder at your Bloomberg a little while ago, looking at a lot of charts, and most of them, commodities, equity charts, they're all going up.
Yeah, we had the Bernanke testimony in Jackson Hole in the end of August, and additional Fed announcements since then have just built up this liquidity-fueled rally in virtually all risk assets, S&P, emerging market equities, commodities, crude oil today, BP, gold.
And yet you don't see a lot of volume. Bob, do you notice that? I mean, things go up, but they don't take a lot to move them up. The volume has been really pitiful this month. Yet again, another low.
We absolutely noticed that. And the interesting thing to me is with the strong September that we've had, as I'm sure you guys have been talking about, historically one of the worst months for the equity markets, with this strong September, even if we get an October scare which investors seem to be always worried about when October approaches, we'll be coming off of a higher base with this strong September. That volume, again, Main Street, retail investors not quite getting back in because the jobs picture hasn't turned around. But I'll tell you, with some of the bad news we've had, some of the lowered earning guidance, we could really be setting up for a good fourth quarter.
Hey, Bob, it's
Dominic. Let's keep things in perspective, though. Time frames down.
Did you say tough quarter? Did you say tough quarter?
What's that?
Did you say tough quarter?
No, I said good quarter.
Good quarter.
I said good quarter.
Okay.
Yep.
Oh, Bob, it's Dominic here. What are the charts? The charts are saying something different, though, right? Ralph Acampora was saying that we could be due for a huge rise here, but possibly 20-some% in the next 10 months. But yet other traders are saying, you know what, there are divergences in the market right now. Bonds are going up at the same time that stocks are. What are you making of all this confusion out there?
Well, definitely from a technical perspective, and that's really what I look at. I look at price action, both in the currencies, in the equity markets. That's the main driver of what I trade, but that's about duration. There's absolutely going to be a pullback in the equity markets after this type of a month. We call that noise in the way that I teach trading. So in terms of once that noise is over, you get to a better base, you build from there and make new highs off of there. Hey, I trade new short-term trends and then break out of old ones.
Hey, Bob, hang on for a second. We just want to walk everybody through the bell. We've got the closing bell on this Thursday, September 30th, 2010, so finishing up the month. In terms of today, this Thursday, finishing off our lows of the session, just down not quite 4 points on the S&P 500, 1141, so down 1/3 of 1%, down 0.4 of 1% on the Dow Jones Industrial Average at 10,788, so a decline of about 46. The Nasdaq down just about 8 points at 2368, so a decline of about 1/3 of 1%. John, I want to ask you, because we're seeing so much momentum here, but on light volume, certainly in the equity trade, do you think the volume, the momentum is to the upside looking into the fourth quarter, or what do you think?
No, I don't. I'm concerned the fundamentals are really leaning against the market. The types of overhangs we have in areas of pension. We've got trouble brewing in China with trade, with Japanese territorial tensions. Europe is obviously a basket case with Ireland and Greece and Italy and Spain.
And you don't see a solution there. I mean, the problems there are real, and you see them continuing.
I've subscribed to this mantra called all for one, one for all, the Three Musketeers, and I do believe that the ECB will suck core Europe into the problems of the periphery. The problem is that the European banks in the central countries, in the core countries, are heavily loaded with problem debts of the periphery country governments and periphery country banks, housing, and so forth. So Europe as a whole looks like a basket case.
But, John, how much of that, though, is already priced into the U.S. stock market? Because obviously earlier this year, pre-September, we saw things going down in large part because of the European perception about what was going on there.
Well, I think there's been almost an unnatural flight to quality into the U.S., which is a little odd
just that statement is odd. Flight to quality U.S. in the same sentence.
Well, exactly. I mean, the budget deficits, the debt to GDP ratio, the off-balance sheet liabilities, Fannie Mae, Freddie Mac are still basket case. U.S. housing, I think we really realistically have to say, is being marked way above market. There's a lot of accounting laxity that caused the crisis, and the accounting community's reaction to that was to make accounting even more lax through additional, fictitious accounting. It's called pretend and extend.
But I hear Bob chuckling the whole time with these short European banks. What's the deal, Bob?
Well, it's funny to me because it's not a chuckle against either gentleman. I mean, both bring up points that I actually agree with. Fundamentally, I don't think there's very many people that have been in the markets for a long period of time that think we're fundamentally sound. But once again, remember, I mean, if you just look behind me, that's sort of where I grew up, right? So I have two trading models. One is 1 to 4 days, one is 1 to 3 months, and I don't look much past that. So from a perspective of fundamentally, to me, fundamental problems coming home to roost is really a duration bet, and I'm not smart enough to make that bet. So all I'm trying to make sense of, to me, is where are we going to get this dip? Is it an opportunity to buy? Based on the fact that, again, fundamentals look terrible to, in my opinion, pretty much everybody I talk to, but yet the market is up on low volume. If we get any volume in, or if we get any surprise where the numbers are a little bit better, especially in the employment situation, I think we get that pop into the end of the year.
You know, we've been having this Bloomberg Dealmakers Summit go out, and there's a lot of players in the private equity world and the M&A world. Roger Altman was one of the folks that we spoke to. He's the co-founder of Evercore Partners, and he talked about, he's talking to a lot of CEOs. They're not really worried about the regulatory environment. They're not worried about health care. Listen to what he had to say, because this is what he says corporate America is really concerned about.
I think the uncertainty that is so widely discussed is less about events in the political and legislative arena and more about the weak final demand that so many executives are facing. When I talk, as Don and Marty do every day, to senior executives around the world, they're not primarily talking about, I hate that health care bill, or, Dodd-Frank was a screwed up piece of legislation. They're talking primarily about the weakness of final demand and the fact that the outlook for the remainder of 2010 is give or take 1.5% real GDP growth. In 2011, again, in the developed world, probably if you take the whole developed world together, it's less than 2%. And that this is such a slow and painful recovery.
All right, so it's Roger Altman there with Marty Lipton, Don Gogol, and our own Pam Fox. His point, though, John, was it wasn't, like I said, regulations, health care. What corporate executives say, they don't see any of that kind of weak, they're seeing weak end demand here, and that's what's holding them back from either hiring or spending CapEx. Until we see any kind of shift in that, nothing's going to really change fundamentally, is it?
Yeah, we've got a terrible unemployment problem, and there seems to be no end in sight. No end in sight to the very low Fed funds rate. Probably going forward over the next 12 months, the Fed will probably be buying about $100 billion of treasuries every month, which in effect means 100% of the net supply of treasuries sold will be bought by the Fed. Now, while that balances out, what it means is that the dollar is at risk of cratering.
But hold on one second, John, because if the outlook is as gloomy as you, and you're certainly not alone, a lot of other people are looking at these negatives as well, then how did the market do so well in September? And isn't the stock market, like Bob, focused more in the short term? And as long as it's that way, we're not perhaps going to see that gloomy outlook have an effect.
That's exactly right.
He came on earlier today. He thinks the Dow's going to be up 23% by next June. And he acknowledges that we could see another shoe drop in real estate, serious European problems, China property bubble. But that, he says, is in the future, and he just wants to ride this wave up till June.
Sort of gloss it over and keep going up.
Yeah, the valuations on the S&P at 12 times PE, that's a pretty attractive valuation. And with interest rates at 2.5% on the 10-year, you're getting pretty low yields. My fear is that if real estate prices fall and asset prices fall and the dollar falls, then you're not doing that well, even if you start out at reasonable valuations.
Hey, Bob, I want to bring you back into this discussion here because Adam and I had talked about this idea that Berini Associates put out this kind of piece saying that it takes a lot more money to force the market down than it does to put the market up again. With the Dow down 50 points today, according to their estimates, it could be about $350 million it took to kind of force this, Dow down about 50 points here. Are you seeing that from your trading? Is it just the path of least resistance to go higher in the stock market as opposed to go lower?
Well, I think based on the price patterns and the price action, this end of the month, end of the quarter activity might bring about a little bit more of that money. So for today specifically, it might be a little bit misleading. But from a trader's perspective, you have to remember one key thing about the way the market moves, hour by hour, day by day, and week by week at the most, okay? It's shorts that make the market go up when they cover. It's longs that make the market go down when they're selling their positions out. Otherwise, the market has a natural upward bias, in my opinion, from 401k plans going into long-only mutual funds. That's the piece that is so much smaller over the last 3 years because of employment, because of people pulling their money out because they need it, and that weak final demand that your other guests have talked about. It's a big problem in terms of the upward bias that the market usually has.
Hey, John, I got to jump in. I've been literally getting hate mail based upon a chart that I showed of the price of gold divided by the SPX. Right now, the ratio is about 1.1. At the height of gold in the 80s, it was 7.5. If what you're saying is true and you can have this trickle up, is gold a logical hedge, and therefore you actually could see gold relative to equities keep moving up?
Oh, absolutely. I mean, we've got indications that central banks around the world want to get their gold balances up. The idea of central banks selling gold is something of the past decades. Going forward, it looks like central banks, it looks like retail, it looks like Chinese, all want to own gold. And I see gold as an inflation hedge, a crisis hedge, and also in a certain way a tax hedge. And if you can get that hedge, I figure at the cost of about $13 a year, because 1% interest rates times $1,300. It's $13 a year. That's a very low cost for that hedge, which normally costs closer to $30 or $40 a year.
And how high could that hedge go?
Can I ask a question here about that? Am I able to jump in?
Please do.
Yeah,
in terms of when, and this is a legitimate question, when you say hedge, in my years in the market, to me, a hedge was always something that you really didn't care if you made money on your hedge or not. It was your main positions. Is that the way you're referring to it?
Okay.
Or do you think it should be a bigger part of most people's portfolio?
You get 20 seconds, John.
Sure. By a hedge, what it means is that if tax rates go up, if inflation goes up, or if you have a crisis and all of your other assets are going down in value, your gold is more than likely in those scenarios going to be going up. So it's a hedge in that sense.
Bob, thanks so much for joining us. I got to say thank you.
Thank you,
John
guys.
Brynjolfsson, always a pleasure from
Thank you,
Armored
John.
Wolf. We have to take a quick break. We're back in 2.